Hi everyone, welcome back. So in this lecture, which is going to be a short one hopefully, we are going to actually discuss a little portion of 5 to 10 minutes, which is going to be very relevant from an examination viewpoint. And after that, we will be discussing something which is absolutely not going to be relevant from an examination viewpoint, but it is good to understand or good to learn because it will open up your brains. You will start probably thinking in the right direction. It might initially start confusing you, but I think it is at least good to know because you will widen up your horizons because of that. Okay, so the first 5 to 10 minutes is going to be very relevant. The later part, I will leave it to you whether you want to watch it or not. It's not going to be relevant, but my recommendation is to watch it. Okay, so firstly I will start off with the formula for P. Okay, in the previous lecture, if you remember, we actually calculated P by you equating the LHS with RHS, where LHS was the current share price of 50 and the RHS was the present value of the expected share price. Why did we do this? It was the standard DCF method, right? The intrinsic value or the current market price today of 50 rupees has to be equal to the present value of the future cash flows. Over here, the future cash flow was only the share price at T equal to 6 because we assume no dividends, right? So the present value of the future share price, but the share price over here could be either 55 or it could be 45 as well. Therefore, we are calculating expected share price by multiplying it with the respective probabilities. These were the risk neutral probabilities is what we learned in the previous session, right? So we take the present value of the expected future cash flow and we are discounting it using the risk-free rate of return, which was 2.5% for a risk neutral investor. Okay, and when we equated that with the current market price, we actually calculated the probability. Okay, we call this the risk neutral probability. This is actually an indirect method. There is also a direct formula for calculating P, which is R minus D divided by U minus D. I will just write down what R, U, and D mean. Okay, R refers to the periodic factor, periodic interest rate factor. Okay, which is nothing but equal to 1.025. Okay, the reason I'm calling it periodic is because 5% was the risk-free interest rate per annum. Okay, but here I'm taking 2.5%, which is actually for 6 months. Okay, so that is the reason I'm actually calling it periodic. And the reason I'm calling it as factor is because I am adding 1 to it. Okay, whenever you call, it's not a hard and fast rule. It's just something that I am speaking in terms of. Okay, when I say factor, it is basically 1 plus R. Okay, and since I've added the word periodic, it is 1 plus R, where R is the periodic interest rate. Okay, so 1.025 is R over here. Had it been, let's say, hypothetically 8% per annum, then it would be 1.04. Okay, the periodic interest rate factor would have been 1.04. If we are evaluating, let's say a 3-month option where the interest rate per annum is 8, then it would have been 1.02 because the periodic factor is the periodic interest rate is 2% and the periodic interest rate factor is 1 plus R, which is 1 plus 0.02, which is 1.02. Okay, and then U over here is nothing but upside factor. If you remember in the very first class, I defined U as 1.1. 1.1 was nothing, 1.1 was U, and we actually calculated this 55 as 50 into 1.1. All right. Okay. Now, if suppose in a question you're directly given 55 and 45 without giving U, then basically U can be calculated as upside share price, which is 55 divided by current share price, right? But in our example, actually, I started off by giving U. Okay, just maybe to refresh your memory, if I come back, if you remember, if you're able to see this, we took an example where U of upside factor was 1.1 and D, which refers to downside factor, is 0.9. Okay, so U for us is 1.1 and D is actually nothing but 45 divided by 50, which is equal to 0.9. Okay, of course, again, what we did was we assumed D to be equal to 0.9 and then we arrived at 45. Over here, we are actually calculating D by assuming that 45 is given, okay? But ultimately, U is an upside factor. If U is not given in the question and instead the share prices are given, all you have to do is upside future share price divided by current share price is U. Downside future share price divided by current share price is D, okay? So this is the formula for calculating probability. I'll show you the derivation of this formula also. Not that I'm, really in favor of derivations, but wherever it is actually nice and interesting, I will actually show you the derivation. Okay, but first let's actually use the formula and see whether the probability that we are getting over here using the formula is the same as what we got earlier. Okay, obviously it has to be the same, but still, okay. So the formula for P, like we saw, was R minus D divided by U minus D, where R was equal to 1.025 minus 0.9 divided by 1.1 minus 0.9. 1.025 minus 0.9 is 0.125 divided by 0.2, which is equal to 0.625. Obviously, 1 minus P, which is the downside move, is equal to 0.375. These are exactly the same answers that we got under this approach where we actually applied, where we equated the LHS, which is the current share price, with the RHS, which is the present value of the expected share price. Okay, if you remember, we got the same exact probabilities. So the formula for P, you need not have any specific preference in examination. You can apply any of the methods, but the formula for P, if you are comfortable with the formula, is P is equal to R minus D divided by U minus D, where R is equal to the periodic interest rate factor. So there are two things. One, it should be periodic. Second, it should be factor. Factor meaning 1 plus R. Okay, where R itself is a periodic interest rate. Okay, we had 5% per annum. So what we did was we first divided that 5 by 2 to get 2.5%. And since we had to take a factor, I did 1 plus 0.025, which is 1.025. D is the downside factor. U is the upside factor. Okay, upside factor, if not given in the question, it can be calculated as upside share price 55 divided by 50, or D can be calculated by downside share price, which is 45 divided by 50. Okay, so P is equal to R minus D divided by U minus D. Okay, I remember that, U and D, I'm still yet to give you the formula for it. I remember I'll give it to you after the single period binomial gets over. Okay. And then I also, I postponed few things, saying like U should be, D is equal to 1 by U and stuff like that. I will all give that in a separate video once the binomial model is completely done. Okay. Now let's quickly have a look at the derivation of that formula. Okay. If you actually take a look at this formula, 50 is equal to present value of 55 into P plus 1 minus P into 45. Okay, I'm just rewriting that formula. 50 is equal to 55 into P plus 1 minus P into 45, the whole divided by 1.025, right? Now, if you actually look at it, first what I'm doing is I'm taking 1.025 to LHS and bringing 50 to the RHS as a denominator. Okay, so it will become 1.025 is equal to 55p, the whole divided by, 55p plus 1 minus p into 45, the whole divided by 50. Okay, I can split the RHS as 55p divided by 50 plus 45 by 50 minus 45p by 50 again. Okay, all I've done is I've basically split the numerator and denominator into the separate components. Okay, 55 by 50 is nothing but U. Okay, so UP plus 45 by 50 is 0.9, is actually D, sorry. Okay, 45 divided by 50 is 0.9, which is D, and minus I have dP again. All right, and then on the right side, 1.025 is nothing but R. Okay, what I then do is I'm moving this plus D to LHS to get R minus D equal to UP minus dP. All right, now if R minus D is equal to, I take P common to get U minus D. Okay, and then the next step will obviously be P is equal to R minus D divided by U minus D, by bringing U minus D onto the denominator. Okay, so this is how that formula has been derived. So the formula has actually been derived from the equation above. So obviously both have to give you the same answers, just that P is equal to R minus D divided by U minus D is a ready-made formula which you can straight away apply. Over here, you basically have to apply that logic. Okay, that logic is where, you know, the current share price is equal to the present value of the expected share price discounted at the required rate of return. Required rate of return for a risk neutral investor is the risk free rate. Okay, so this is, over here there is logic, over here there's absolute just formula. Okay, so there are basically three determinants of the probability. One is the risk free rate of interest, which impacts probability in the numerator. The second is the upside share factor, which impacts it in the denominator. And the third is actually D, which is the downside factor, which impacts both the numerator as well as the denominator. Okay, so these are the three factors. Of course, within R there is also time to maturity. Okay, because we are dividing it by 2, right? So within R is time to maturity as well. Okay, so but broadly speaking, there are basically three factors: R, U, and D. Of course, there's also time to maturity component. Okay, and then over here, so just note that if at all you keep changing R, which is the risk-free interest rate or the periodic interest rate factor, P keeps changing. Okay, so now I am moving into that area which I said is not relevant from an examination viewpoint. Okay, but it'll be good to know again. I'm repeating that. Okay, so now uh, let's say that the discount rate as per CAPM for a share is 16%. I'm just hypothetically assuming something. This is obviously derived using the formula RF plus beta into RM minus RF. Okay, I have not given you what RF is, what beta is, and what RM is. I've straight away given you the output of CAPM, which is 16%. What does this 16% actually indicate? If I, as a risk-averse investor, want to invest in this share, I'm not talking about an option, I'm talking about a share. If I want to invest in a share where the current share price is actually 50, and that can go either up to 55 or it can come down up to 45, right? So with these conditions, I expect a return on this share of 16%. Okay, this is my required rate of return. Okay, now let us assume that the probability, now I'm assuming myself to be a risk-averse investor. Okay, so I'm denoting the probability of 50 becoming 55 as Q and 50 becoming 45 obviously as 1 minus Q. Okay, so now if you actually look at it, the current share price, which is 50, should actually be a reflection, should actually be nothing but the present value of the future cash flows discounted at the required rate of return. Okay, the current share price 50 is equal to the present value of the future expected cash flow, where expected cash flow is nothing but 55 into Q plus 45 into 1 minus Q discounted at the required rate of return. Now I'm not a risk neutral investor anymore. I'm a risk averse investor. So for me, the required rate of return is not risk free rate in this case. It's actually going to be 16%, right? Okay, so now if I put that equation down, 50 is equal to present value of 55 into Q plus 1 minus Q into 45. Here is Q the risk neutral probability? No, The Q, I mean Q over here is actually the probability that would have been assigned by a risk-averse investor. Okay, because I am over here now going to discount it not at the risk-free rate of return, but I will be discounting it at 8% for 6 months, because the 16% was for 12 months. So 8% is for 6 months. Okay, and then I'm solving for the value of Q by 50 is equal to 55Q plus 45 minus 45Q, the whole divided by 1.08. If I move 1.08 onto the LHS side, it will be 50 into 1.08 is equal to 10Q plus 45. Okay, 50 into 1.08 is going to be 54. 54 is equal to 10Q plus 45. Okay, and then if we further solve for it, it will be 10Q is equal to 9, 9 being 54 minus 45, and Q will be 0.9, which means a risk-averse investor, to get a rate of return of 16% on this share, he will have to assign a probability of 0.9 on the upside and a probability of 0.1 to downside. Okay, which means if a risk neutral investor is, if a risk averse investor, I'm sorry if I said risk neutral earlier, it's risk averse. Risk neutral is 0.625 and 0.375. Risk averse investor, if a risk averse investor actually buys a share today for 50 rupees or $50, okay, and if he has and if he wants a return of 16%, then he should assign a probability, or he would have assigned a probability of 0.9 to an upside move and 0.1 to a downside move. Okay, such that the expected share price is 54, which is again lying between 55 and 45. It is obviously closer to 55 because the weightage is 0.9 on the upside, right? So he expects to receive 54 on an average at the end of which is at t equal to 6, with a current share price of 50. Okay, in such a way that the return that he gets is actually 16% per annum or 8% for 6 months. Okay, so the probabilities that a risk averse investor would have assigned is actually 0.9 and 0.1. Okay, these are the real world probabilities, given the assumption that the CAPM required rate of return is 16%. Okay, of course, CAPM required rate of return, we have assumed a value. If this 16% keeps changing, then obviously your 0.9 and 0.1 also will keep changing. Okay, like we saw above, P over here is actually a determinant, R is a determinant of P, right? So R is nothing but the rate of return or the required rate of return. If I keep changing 16% into a higher value, then the probability, the upside probability, the numerator is going to increase, which means obviously the probability will increase. If I decrease the interest rate, the numerator is going to decrease without having any impact to the denominator. Therefore, probability will of course reduce. Okay, so since if you actually observe, I moved the discount rate from 2.5 to 8%. Okay, when I move the discount rate from 2.5 to 8, the probability, the upside probability has moved from 0.625 to 0.9. Okay, that itself shows that there isn't a direct relationship. When risk-free interest rate goes up, the probability, when the rate of interest goes up, the probability goes up as well. Okay, so Q over here is 0.9, and 1 minus Q, which is obviously the downside risk factor, is 0.1. Okay, these are the real world probabilities. Real world probabilities or risk averse probabilities. These are the probabilities that would have been assigned by a risk averse investor. I'm again saying would have been assigned because we have calculated probability using a formula. Probability is actually never calculated using a formula. It's always assigned, right? Based on your future expectations and based on past data. But over here, what we are saying is a risk averse investor wants a return of 16%. And if he wants that return, he should have assigned a probability of 0.9 to the upside factor, to the upside move, and 0.1 to the downside move. Okay, so over here also the probability is actually backed out, But the backed out probability is not the probability that a risk neutral investor would have assigned. It is the probability that a risk averse investor would have assigned. Okay, the reason being the discount rate that we used over here is actually the required rate of return for a risk averse investor. Okay, remember again, over here, we actually applied the values of share. We have never brought in the question of option payoff, right? We're thinking purely from the payoff of a share. Okay, so a share, a cash flows of a share are always discounted using CAPM. What I said initially was that the discount rate for an option is unknown. I never said that the discount rate for share is unknown. Okay, the discount rate for calculating, present value of a the discount rate for calculating the present value of a cash flows arising from a share are always discounted using CAPM or APT or other alternative models. Okay, the discount rate, there's no model to calculate the discount rate for a option. Okay, so coming down again, I'm just recreating that binomial model. 50 has gone up to 55, or it can come down to 45 with a probability of 0.9 on the upside and a probability of 0.1 on the downside. Okay, now I'm bringing, sorry for this. Apologies. Yeah. Okay, now I'm bringing an option into picture. Option payoff can be either 7 or it can be 0. Okay, the probability that it will be 7 is 0.9 and the probability that it will be 0 is 0.1. Okay, so the expected value of a call option is equal to 7 into 0.9 plus 0 into 0.1, right? Which is equal to 6.3. And this 6.3 is expected value for a risk averse investor. And the reason it is expected value for a risk averse investor is because the probability with which we have multiplied is that of a risk averse person. It is not the probability of a risk neutral person. It is the probability of a risk averse person, right? So obviously the expected value of a call option that you have at at t equal to 6 of 6.3 is the expected value of a call from the viewpoint of a risk averse person. Okay. Now the standard DCF technique says that the value of a call option at t equal to 0, value of a call option at t equal to 0 is equal to present value of the future expected payoff. Okay. Present value of expected payoff, where expected payoff over here is actually 6.3. We have calculated this. Okay, this is $6.3. The thing that we actually do not know is what should be the discount rate to take the present value. Okay, we actually started off from this point. Okay, we do not know how much risk premium option investors require because we do not know, we don't have a model to capture the risk preferences or the risk aversion of option investors. Okay, so that is the whole point. That, this was the roadblock that we actually faced when we were trying to value options using a standard DCF technique. And therefore, we resorted to alternative methods like the risk neutral method, where we assumed that the person who's valuing is not a risk averse investor, it's a risk neutral investor. Okay, and the other alternatives were the delta hedging approach or the risk neutral method and so on. Okay, so now, but what we can do is, I know that the value of a call option today should actually be 4.27. Okay, I know the answer. Okay, now I'm going to calculate the discount rate which is actually implied in this formula. Okay, so given that I know the option premium of 4.27 because I've calculated it using the other models. Okay, 4.27 should be equal to 6.3 divided by 1 plus R, where R is nothing but the required rate of return, for a risk averse investor, for investing in options, for buying options. Okay, remember this is sorry, give me a second. Remember, the required rate of return for buying a share for a risk-averse investor is the CAPM discount rate. Okay, so if a risk-averse investor goes to a marketplace for buying a share, his required rate of return is going to be captured through the CAPM. Okay, but the required rate of return that a risk-averse investor wants from an option, we do not have any model yet. We are now calculating the implied rate, given that we know what the value of the option is. Okay, if you actually calculate, it is nothing but 1 plus R is equal to 6.3 divided by 4.27, which is equal to 1.4754. Okay, which means R is equal to 47.54%. Okay, this is the required rate of return for a risk-averse investor for buying an option. Okay, a risk-averse investor who has a required rate of return of 8% for 6 months for buying a share needs a return, or requires, his required rate of return is 47.54%. 47.54%. It's huge. I mean, look at the difference between 8 and 47%, right? Okay. His required rate of return for entering the options market is 47.54%. Okay. We have calculated this by backing it out, given the value of the option today is known. Okay. What I initially started speaking was, when we were initially talking about the discounted cash flow technique, we did not know about the value of the option. Okay, we wanted to calculate the value of the option, and we said that the discounted cash flow technique cannot be used because we do not know R. Now what I'm doing is, given that we know the value of the option, I am calculating the discount rate which is implied in the option valuation for a risk-averse investor. Okay, the risk-averse investor who requires a return of 16% for buying one share per annum requires, actually, it is 47 into 2, which is 94%, or nearly 95%, which is huge. Okay, he requires a return of 95% per annum for buying options. Okay, with this only you can actually get a feel that options market is very, very, very risky when compared to the share market, and that is the reason the discount rate for options is actually much higher than the discount rate that is needed for buying a share. Okay, many of you might have also got a doubt that options actually derive its value from the underlying share, right? For instance, in the payoff that we had over here, the value of a call option of 7 and 0 was actually the call option was deriving a value of 7 and 0 from the underlying share itself, right? So obviously the first thought that you get is CAPM must also be used as the discount rate for option valuation. Okay, you might have thought saying calculate the expected value of a call option, discount it using CAPM discount rate, we will get the option value today. Okay, over here only it is actually clearly visible that discount rate cannot be CAPM. Okay, because the CAPM discount rate that we started off was with 16%, whereas the discount rate which is implied in an option value is actually 47.54%. For 6 months it was 8%. CAPM was 8% for 6 months. Here it is 47.5% for 6 months. Okay, if I would have used CAPM over here instead of using 47.5%, this option value would obviously not have been 4.27. And we know that all the models should actually give the same option value, right? I mean, you had delta hedging, which gave you 4.27. You had portfolio replication, which gave you 4.27. So the option value has to be 4.27. Okay, let's not argue that, option value that we calculated using the other methods is incorrect. Okay, 4.27 is absolutely right. And then we backed out the discount rate, and the discount rate that we got was not equal to CAPM, which by itself explains that CAPM cannot be a discount rate for valuing options, right? Okay. So I think that is the thing that I actually wanted to cover in this lecture. So there are two things that I was trying to mention. One was the discount rate for valuing options by a risk-averse investor is going to be much, much, much higher than the discount rate that you would get when you compare it with the discount rate as per CAPM. Okay, because the options are considered much more riskier than shares in general. Okay, the second point that I also wanted to mention was in the previous session, I don't know how many of you actually remember, I said that uh, the numerator, I think the numbers were 4.375 divided by 1.025. These were the numbers that we actually finally arrived at when we were calculating the value of the call option today. I said that the value of call option today should be expected value of call divided by 1 plus risk-free discount rate, right? I'm just checking whether 4.375 was the right number. Yeah, it was. Okay, 4.375 was the expected value of a call option, which was nothing but 7 into 0.625, okay, divided by the risk-free rate of return. Here, we use the risk-free rate of return because a risk-neutral investor wants a risk-free rate of return from both option and the share, okay? Therefore, even when we were calculating the upside probability above for a risk-neutral investor using this formula, we used a discount rate over here rather. When we were doing the present value of the expected payoff for a share, the discount rate that we applied was 2.5% because the required rate of return for a risk neutral investor for buying a share is 2.5%. Similarly, when we were calculating the value of the call option today, we know that the call option's risk characteristics are completely different from that of a share, but still the risk neutral investor wants 2.5% because he's risk neutral, right? I mean, so 2.5% is his required rate of return, whether it's an option or whether it is a share, okay? And I said that when we actually use it when we actually try doing the same thing in the risk averse world, the numerator actually goes up. And if you see, 4.375 has gone up to 6.3, all right? Because then the reason it has gone up is the probability, the upside probability has actually gone up, okay? The upside probability was nothing but P equal to R minus D divided by U minus D, okay? Between a risk neutral world and risk averse world, U and D are actually not going to change. U and D are going to remain the same. What is going to change is R, where R is nothing but the required rate of return on a share, okay? R over here has gone up for in a risk averse world, and therefore the numerator has gone up because P has gone up, okay? When R goes up, P goes up. When P goes up, the numerator value goes up, okay? And then we also saw that the discount rate for an option over here has also gone up, okay? The R that is used over here is the expected return of share, which is why we actually used 1.08, okay? And the R that is used over here is actually that of an option. The discount rate that needs to be used is that of an option, okay? The thing, sorry, give me a second. I don't know what happens sometimes, but fine. Sorry for that line in between. The R that needs to be used when you're calculating the value of a call option should be the discount rate that is there should be the required rate of return for investing in an option, okay? Because value of a call option today is the present value of the expected value of a call, expected payoff, discounted at the required rate of return from an option, right? Because when you're calculating the present value of option, you need to use the relevant discount rate for an option. When you're calculating the present value of a share price, the discount rate that you need to use is the CAPM discount rate. For a risk neutral investor, it does not matter whether you're calculating a share, the present value of a share or present value of an option, because both of them are risk-free rate, right? So in a risk averse world, I mentioned that the numerator goes up, which we saw has gone up from 4.375 to 6.3. The denominator also goes up. Like we saw, it went up from 2.5% not to 8%. It has gone up to 47.54%. Okay, the denominator over here has to reflect the riskiness of the option payoff, which is 47.5%. Okay, the numerator has gone up because the discount rate for share has gone up. Okay, I will repeat myself. When you're calculating risk neutral world, you had expected value of a call of 4.375, and then you used a discount rate of 2.5% because that was your required rate of return, the risk-free rate. When you're calculating the same thing in a risk averse world, the numerator goes up. Why? Because when you're calculating the probability of upside move, the probability now includes the required rate of return for a share. Okay, and the required rate of return for a share is captured through CAPM. Okay, so using CAPM, we are using 8% instead of 2.5%. Okay, so when R goes up, R meaning the required rate of return on share goes up, the probability goes up. When probability goes up, obviously the expected value of a call option goes up. We saw that it went up from 4.375 to 6.3. Okay. On the denominator side over here, the expected value of a call option should be discounted not using CAPM, but should be discounted using a rate, which is another discount rate, which is specific to option payoff riskiness. Okay, which we calculated as 47.54%. So the discount rate over here in the denominator has actually gone up from 2.5% to 47.5%. Okay, and we also cleared it that CAPM is obviously not going to be equal to the discount rate that is required for discounting the payoff of an option. We did not prove it exactly like upfront, but we proved it using corollary, right? Because the answer that I got as R was 47.54, which was not equal to 8%, right? So the discount rate for options is not equal to the CAPM discount rate. Okay, so that is what I actually wanted to cover through this lecture. It could have gotten a little heavy, but I would say maybe if you have the time, please do rewind it and watch it once again. I think it will get clear. Okay, and so far as I think with this we are actually done with single period binomial. Maybe I might take a class for a few sums, or I don't know, I'm not too sure. We will then move on to two-period binomial model. The risk neutral method is exhaustively used in two-period binomial. In fact, if you actually see under the single period after the single period binomial, I said we have two-period binomial, and under the two-period binomial, we actually have the same approaches as single period binomial. Same approaches meaning the delta neutral method or the delta hedging approach, portfolio replication, and risk neutral method, right? But what is exactly used is actually risk neutral valuation. The other two are not used at all. Okay, so I will definitely devote one lecture for risk neutral valuation. Delta hedging and portfolio replication, both are actually one and the same. I mean, they're derived from one another. So I will probably maybe spend some time on delta hedging. I would try to drive home one concept which is going to be used later on in Black-Scholes. Okay, so I think that's the plan. So I think I've given you the plan for 2 lectures from now, and then after that it will be Black-Scholes model. God knows how many lectures.